welcome to this comprehensive video. If you are looking to understand Forex from A to Z, you are in the right place. Today, we are going to dive into the heart of the largest financial market on the planet. We will break down how it works, understand who participates in it, analyze the tools used by professionals, and above all, I will share with you the risk management secrets that make the difference between a trader who survives and a trader who blows up their account. Grab something to take notes, because the next few minutes will transform your vision of trading. Let's start with the absolute basics. What is Forex? The word Forex comes from foreign exchange, which means the foreign exchange market. It is the virtual place where global currencies are traded against each other. Unlike the traditional stock market where you buy shares in companies like Apple or Tesla, in Forex, you are buying money. You are betting on the value of one currency against another. The size of this market is simply colossal. The daily trading volume on Forex exceeds $7 trillion. To give you some perspective, that is more than 20 times the daily volume of all global stock markets combined. This immensity makes it extremely liquid. This means you can buy or sell huge amounts at any time, without ever struggling to find a buyer or a seller on the other side. But why does this market exist? Originally, Forex was created to facilitate international trade. Imagine a European company buying cars from Japan. It cannot pay in euros. It must exchange its euros for Japanese yen to pay its supplier. It is these billions of commercial exchanges, tourist transactions, and international investments that create the permanent price movements on which we, retail traders, are going to speculate. Now, how does Forex trading actually work? The golden rule is simple: you always trade in pairs. You cannot just buy the euro. You must compare it to another currency. The most traded pair in the world is the euro-dollar, noted as Eurist. When you see a displayed price, for example, 1.1050, it means it takes 1.1050 US dollars to buy a single euro. In this pair, the first currency, the euro, is called the base currency. The second, the dollar, is called the quote currency. If you think the euro will strengthen against the dollar, you buy the pair. This is called going long. If, on the contrary, you think the euro will weaken, you sell the pair. This is called going short. The beauty of Forex is that you can make money whether the market goes up or down, as long as you correctly anticipate the direction. Not all pairs are created equal. They are divided into three categories. The majors always include the US dollar. These include euro-dollar, British pound against US dollar, or US dollar against Japanese yen. They are highly liquid, and the fees are minimal. Next, we have the minors, which do not include the dollar, such as the euro against the British pound. Finally, there are the exotics, which involve a currency from an emerging country, like the US dollar against the Turkish lira. As a beginner, stay focused on the majors, as they are more predictable and less expensive to trade. A frequently asked question is, when can you trade? The answer is fascinating. Forex is open 24 hours a day, 5 days a week. As the sun rises successively in Sydney, Tokyo, London, and New York, the market never sleeps. However, not all hours are equal. The market is divided into sessions. The Asian session is often calm. The European session brings volatility. But the most favorable time for trading is the overlap between the London and New York sessions, between 1 p.m. and 5 p.m. Paris time. This is where 70% of the movements occur. Let's get practical with a fundamental concept, the pip. A pip is the smallest unit of price variation. On the euro-dollar, if the price goes from 1.1050 to 1.1051, we say it went up by 1 pip. It is the universal unit of measurement to calculate your profits and losses. But be careful, a pip does not have the same value depending on the size of your position. This is where the concept of a lot comes in. In Forex, we trade in lots. A standard lot represents 100,000 units of the base currency. If you trade one lot of euro-dollar and the price moves 1 pip in your favor, you earn $10. If you trade a microlot, which is 1,000 units, you earn 10 cents. Understanding the value of a pip is mandatory to master your risk. And this is where we address the most dangerous, yet most powerful point of Forex: leverage. Leverage is a tool provided by your broker. It allows you to open positions much larger than your initial capital. For example, with a 100-to-1 leverage, you can control a $10,000 position with only $100 in your account. It is a double-edged sword. If the market proves you right, your gains are multiplied. But if the market turns 1% against you, your $100 margin is lost in the blink of an eye. Leverage is not a toy, it is a precision tool that demands absolute mastery. This is why transaction fees are of paramount importance. In Forex, the main cost is called the spread. The spread is the difference between the buy price and the sell price. If the euro-dollar shows a buy price of 1.1051 and a sell price of 1.1050, the spread is 1 pip. This is the commission your broker takes on each trade. The more liquid a pair is, the tighter the spread. This is why you should avoid exotic pairs where the spread can sometimes exceed 10 pips, making trading much more difficult. Now, how do you know which way the market will go? Traders use two main methods of analysis. The first is fundamental analysis. It involves studying the economic health of countries. We look at interest rate announcements, the unemployment rate, inflation, or the gross domestic product. The basic rule is simple: if a central bank raises its interest rates, its currency strengthens, because investors are seeking a better return on their capital. Monitoring the economic calendar is therefore a mandatory daily step. The second method is technical analysis. Here, we ignore the news. We only study the price chart. We look for trends, supports, resistances, and we use Japanese candlesticks to read market psychology. A Japanese candlestick shows the opening, closing, highest, and lowest price of a given period. The shape of the candlestick gives you a clue as to who is in control of the market, buyers or sellers. A good trader often combines both analyses, fundamental to understand the overall direction, and technical to find the perfect entry point. But know that the greatest difficulty in trading is neither technical nor fundamental. It is psychological. The market is a mirror of your own weaknesses. When a beginner wins 3 trades in a row, they feel invincible. They increase their position size, they remove their stop loss, and that is when the market brutally punishes them. Conversely, after a few losses, fear sets in. The trader no longer dares to take a trade, or worse, they immediately try to make up for it by taking disproportionate risks. This is called revenge trading. Mastering your emotions, patience, and discipline represent 80% of the work of a profitable trader. To help you maintain this discipline, there is an essential shield: the stop loss. The stop loss is an automatic order that you place in advance. You tell your broker, if the price drops below this level, close my position immediately, no questions asked. It is the red line that you must never cross. The worst enemy of a beginner trader is their ego. When they are losing, they often hope the market will bounce back, and they move their stop loss further away. This is how small losses turn into financial catastrophes. Cut your losses quickly, and let your profits run. Because all of this is useless without the ultimate pillar of survival: money management or risk management. The golden rule, the one that all professionals follow, is this: never risk more than 1 to 2% of your total capital on a single trade. If you have 1,000 euros in your account, your maximum loss on a trade should not exceed 10 or 20 euros. It sounds ridiculous? Maybe. But this method mathematically guarantees your survival even if you have 20 losses in a row. The goal of trading is not to double your account in a week, it is to still be here, and profitable, in 10 years. Finally, before you start, you must build your trading plan. A trader without a plan is a casino gambler. Your plan must define which pairs you trade, at what times, what your entry strategy is, where you place your stop loss, and where you take your profits. Furthermore, I highly recommend starting with a demo account. It is a virtual account with fake money, but with real market prices. Spend at least 3 months on a demo account to prove you are profitable before risking a single penny of your hard-earned money. In conclusion, Forex is a fascinating world, full of opportunities, but unforgiving for those who venture into it without preparation. Learn to read charts, understand the impact of the economy, master your emotions, and protect your capital like your own life. If you apply these principles with iron discipline, trading could become an incredible source of income. Never forget that trading involves the risk of capital loss, and this video is primarily educational. If you enjoyed this video, subscribe to the channel so you don't miss our next in-depth guides. Like the video, and tell me in the comments which currency pair you want to learn to trade first. See you soon, and trade with caution.